Hello and welcome to M&A Murders and Accusations, the good, the bad, and the ugly of selling your business. We dig into what you need to know and how not to kill the sale of your business. Now here's our host, Rick J. Krebs, Mergers and Acquisitions Advisor.
Hello, everyone, and welcome to our podcast. I'm really excited about our show today. Our guest, Van Carlson. He is the founder and CEO of a company called Strategic Risk Alternatives, or SRA 831B Administration. So you're going to tell us a little bit about that, Van, but I'm excited about this because this is something I haven't heard of. I'm always on the lookout for ways we can help our clients save taxes or reduce their risk when they're selling a business. So, Van, let's start with, tell us a little bit about yourself and how did you get into this?
Yeah, so Van Carlson, I live here in the great state of Idaho, and truthfully, I got into risk management right out of college. I started this property casualty agency from scratch. I started in a little town called Meridian at the time. It had 23,000 people in it, and now there's like 130,000. I always tell people, if you want to be successful in the property casualty insurance business, just move to a really small town and then let it blow up. You'll win all the awards. That's the secret sauce to running the property casualty agency successful. But leading up to 96 and then getting to 08 is really when I got into this new company called SRA 31B Admin. It was really due to the Great Recession. And like when you start out as any business owner, you wear all the hats, and as time goes on, you start to be able to afford to give other hats to other people within your company. And the one hat I kept was with working with business owners, just like you. I mean, I get a lot of joy working with business owners. And unfortunately, when 08 hit, I saw a lot of those business owners go out of business. And it was because most of it was because they knew leverage. They knew how to take advantage of the accelerated appreciation. Looking back, that's a form of insanity. Every time you do that, you're just betting next year is going to be better than this year because you didn't pay for the equipment, you financed the equipment, and now you're carrying debt forward. I'm all about buying equipment but it needs to be a strategic growth, not because you're trying to lower your tax bill. You buy more equipment. However, leading into 08, that was the common theme. I mean, it helped me, and I love fourth quarters in the P&C business, the property casualty insurance business, because business owners would call and say, hey, what's it going to cost to insure 2 more trucks and a skid steer because my CPA says, $80,000 in taxes this year. So it was those types of things that were going on, and some of that hasn't changed, unfortunately. I think you're seeing we're hearing, and I haven't really paid attention to it. I know accelerated appreciation scales going down, it sounds like, but I got to dive into that. I haven't looked into that too much. But anyway, the financial risk business owners take sometimes is discounted because we're optimistic people. We're looking to grow the company. And so that's really when I was exposed to a business owner that had 7 or 8 of these different plans. And we'll get into the plan. The 831B is just part of the tax code, no different than the 401k. But I saw a gentleman that had 7 or 8 of these plans in place, and he was a bit large RV manufacturer. Man, he just took it to a whole nother level for me. And that's really where the light went off for me. Is like, man, business owners need to understand this. What we're going to talk about is a tool that's utilized by very large companies. It's a code that's been around since 1986. It was in the 86 Reform Act. If you look behind me right here, there's a Time magazine here that says, sorry, America, your insurance has been canceled. That Time magazine came out in March of 1986. We almost are identical. We're about 3 years from 86, from where the cycle started back in 1983. Where insurance companies started doing what they're doing today, excluding, getting out of markets, increasing rates. Very similar in economics. High interest rates started clicking up. They were locked into low yielding type investments. They couldn't get out of them. Meanwhile, inflation started kicking up, and they weren't able to insure the amount of risk they had on the books relative to the premium they were collecting. All these things become issues, and it's very similar to what's going on today. And one of the problems today is selling a business and being able to get insurance for it. I could tell you specific stories where it killed selling of businesses because the new owner could not get insurance where it was affordable enough because they had no track record as the new owner of that business.
Wait a minute.
It's like a new driver, right?
Hold on a sec. So you've seen transactions where insurance killed the deal.
Yeah.
Or lack of insurance.
Well, the affordability of insurance.
That's what's important. Yep. That makes sense. Like I sold a logistics company a few years ago, and I was talking to the new owner. He's like, Rick, my insurance is killing me because they didn't have the track record, or even if he does have the track record, those premiums are going up.
Yeah. Oh, yeah. Across the board, 20, 30%. And
wow, 20 to 30%.
Oh, yeah. It's 21, 22. And if you own a lot of commercial real estate in the transaction, it's even gotten worse.
Yeah, that's incredible. Well, let's before we get into it, we gotta hear something cool about you that a lot of people wouldn't know.
We kind of hit on it. I grew up as a farm kid, and I'm hoping to go back as a farm kid. So right now I'm in the process of negotiating buying a farm/ranch, and it's an interesting progression of life. I guess it goes full circle, right? But now that I'm starting to have grandkids, my kids are having kids, and it just puts a new light on everything. Where I'd love to have my grandkids. My kids weren't exposed to farm life like I was. I think that happened to a lot of people in our generation. But it'd be kind of cool to go back and at least get the grandkids out there and maybe see how a sheep is born, seeing a lamb being born, or seeing how stuff is grown, and just that nature's life processes that we do, and more importantly, just be able to source all your own food as best you can. Anyway, would be some.
Anyway, farmer van. I'll be farmer van.
Yeah.
So take care of that. The listeners know I do that on every episode because we want to know a little bit about you. I get to know you, but I'm way excited to hear about this 831B. And so tell me, first of all, what is 831B?
Yeah. So like I was saying earlier, it came out in 1986. And what was happening in 1986, it was under the 86 Reform Act, which by and large was our biggest tax reform in the history of our country at the time. And it continued.
Wasn't that Reagan that was in?
Yeah, Reagan and Tip O'Neill, right? I mean, that was when there was actual, I would say, a functioning government at some point. That's my only
topic. Okay. And they worked together, but that's cool. Go ahead.
Yeah, and what back then it was farmers, ironically, that were finding themselves self-insuring crop insurance. And there was also, like I said earlier about the Time magazine, people had one claim, they got non-renewed or they got canceled. And so when you look at all the things that were going back in there, the Congress said, okay, well, we got to create an incentive. If these people are going to have to self-insure their risk. So the IRS says to people, say, if you got this risk, you can't just take self-insuring risk is not a deduction. You can't just take $1 and set it off to the side, say if something happens, I'm going to use this $1, I'm going to deduct that. IRS says, no. The year you incur the income is the year you pay the taxes. So Congress came out with the 831B tax code. So 831B is just that. All that is where you find in the state the tax code. No different than the 401k. 401k is a tax code. Three numbers in a letter is going to be a tax code. And so in 86, they got together and said, hey, we're going to create this incentive. You can own your own. Basically, it's a form of owning your own insurance company. Right. You can expense it at the operating company level, dump it into an 831B plan. Those premiums stay tax deferred. The vehicle is a C corp though, so we help the clients. For example, we're an administrator, no different than the 401k administrators administer your 401k plans.
Gotcha.
There's rules and regulations to all these codes, as you can imagine, and you need an administrator in the middle there to make sure the guidelines are being adhered to, and that's what we do. But one of the things that we're making sure is this box feels and looks like an insurance company, and there's a 4-part test to it and all this kind of stuff. But The incentive was $1.2 million a year you can put into this thing. And that was really for self-insuring risk. And at the time, there was a lot of that going on, and eerily very similar to what's going on today. And then on top of that, you put in 08, and then you put in COVID, right? There's a lot of self-insuring risk business owners take on every year that unbeknownst to them. And it's getting worse. Insurance companies, in one way, they can only charge so much premiums. There's state regulations involved. They're just going to keep adding more exclusions in there. I literally just looked at a policy before I came in here anyway, I don't want to, the risk profile sheet. I read the policy and I was like, I have no idea how this policy would cover anything. There was so many exclusions in it that I was like, I couldn't even think of a scenario where this was going to trigger coverage. And so anyway.
Wow. You're paying money for it, right? Throwing money.
Yeah, $250,000 a year in premium. Yeah, it was crazy. Anyway. So those are the things that we're risk managers. I mean, first and foremost, I mean, we get geeked out reading insurance policies, and thank God I got those people still exist out there because I don't sleep very well. So this first thing I start doing is if I can't sleep, I pick up a policy, not a book, and you can go to sleep quickly reading an insurance policy. But No, so the exclusions are coming in, all that stuff's going on, and the incentive was created by Congress. Now, the downside of all that, and one of the challenges why you may have never heard of this code was, when I first looked at this in '08, it was so darn expensive to do it. Only big companies were doing it anyway. There was 8 states promoting you to own a captive. These are called captive insurance, micro captives. We call them 831B plans. No different than a 401k plan. You're taking advantage of a tax code. It's an 831B plan. The reality, though, is 8 states were promoting it for you to have these vehicles owned in the states. Now there's 34. A lot of the big companies all gone offshore. I mean, they're in Caymans, Turks and Caicos, St. Kitts. I mean, there's thousands of insurance companies owned in one building in Bermuda. But these are big, large companies doing that. And it was so darn expensive that it didn't make sense for the small to middle market business owners, which were my clients. So when I started this thing out, I wanted to make sure, first and foremost, it was affordable, meaning fees couldn't kill a deal, because you're basically you'd be better off just paying your taxes and going home. We want to make sure the client wins, because the other nice thing about these C Corps, it's a C Corp, so down the road, they may be able to declare a dividend or shut it down as a capital gains and pay long-term capital gains, or long-term dividends as a capital gains is the same rate. So they can win on that arrangement. But meanwhile, though, there's still a lot of risks that business owners take on. And that's really what happened. However, it did get abused. It got used as a state tax tool. The IRS doesn't like this thing. Anything to the benefit of the taxpayer, the IRS isn't going to like. And unfortunately, it's been abused. The state tax attorneys were promoting this as an estate tax play back in the late 2000s, 2008, 2009. There was a lot of incentive for people to abuse it, unfortunately, because the state taxes were so low at the time. They were willing to take the risk. And it's come back to bite several people in the butt on that. There's like several cases the IRS likes to promote as they won this against the taxpayer. But I tell business owners all the time, if your sole motivation is a tax deferment or tax avoidance, we're not for you. And we're risk managers. We don't care what your tax liability is, truthfully. Your state tax attorney or your tax attorney or CPA, or they may care. We can't. We're the risk manager. We understand risk. We understand the risk you're taking. And here's what it comes down to, Rick. Do you want to use pre-tax dollars or after-tax dollars? I want to make it that simple for the business owners to understand. Meaning, if you're going to retain this risk, and there's no way for you to buy a policy, or there's so many exclusions in it, it's not going to do anything for you. Do you want to use after-tax money or pre-tax money?
Yeah. Now let's talk about that for a minute. So let's say we're doing a $10 million deal. What this means is if you're paying the taxes, your pre-tax dollars are $10 million. So you'd have $10 million because you have not paid the tax. You have $10 million to invest or to spend versus $7 million. The IRS and government's going to take 30 to 40%. So,
well, and here's the thing about what you do. I mean, I think there's an inherent amount of risk that the good, the bad, the ugly, like you start your pot, and the name of the podcast is, there is some good, there's a lot of good, obviously, but there could be some bad and ugly. And the ugly I've seen is when rep and warranties weren't there. Or you had one of your key employees that you thought had a non-compete go start up a company the next day, and now you're being sued over it. I mean, all of those little things that go on. And one of the things that we talk to business owners it's a transactional risk. Now, you can buy transactional risk out there. Actually, insurance companies are responding to the M&As out there, but they're coming out with policies. And again, I have not yet heard where the M&A triggered coverage yet. However, they're very expensive to buy. And sometimes banks will even force you to have some kind of M&A or, transactional risk on if they're going to finance it too. So I've seen that as well.
Yeah. So let's talk about transactional risk, because this is something that some business owners, most of my business owners have never sold a business before. They don't know what they're getting into, right? It's the single largest financial transaction of their life. It's their only time they're going to do it. And there's certain things that they don't understand. And that's why we do the podcast. And so what Ben's talking about here, correct me if I'm wrong, is there's a certain element of risk in the transaction itself. Reps and warrants. The sellers will make representations and warrants, or sometimes I'll see them where their partner will make a representation warrant. They didn't even make it, but yet they get entangled in the legal web afterward, right? So talk to me about what transactional risks are that you've seen.
Yeah. So one of the things we do with right away is a dispute resolution. So dispute resolution is a form of a general liability which triggers legal defense counsel coverage. But a dispute resolution that we offer is much broader and it encompasses much more broader coverages for specific disagreements between contracts being written. Somebody says, "Hey, you're not honoring the contract." Now you're being served, and now there's a lawsuit pending. It's going to cost money to defend yourself in those situations. So that triggers that. And in the rep and warranty is where basically, hey, your blue sky was X. It's not X. It's something else. Or, hey, you knew all along. They accuse you of losing a major customer that you knew that was leaving, and you didn't disclose that. I've seen it in so many different avenues. I mean, that's what you live and breathe to do, right? I mean, you put every dang dollar back in your company. Now you've got a buyer, and you want to make sure it goes through. But there is an inherent amount of transactional risk on that. And then, too, a lot of times business owners are carrying their own note. So now you got what happens when the seller is not in leading up to his part of the deal, where he's not making payments or all that kind of stuff. And now you got to take action, or you got to go back after the business. I mean, all of that stuff goes on. The other thing is warranties today. I mean, most of your small to middle market business owners, man, they give out a lot of warranties. And we talk about that as one of the largest unfunded liabilities on their books is how do you fund for warranties?
Mm-hmm. Like you mean warranties that the sellers make, or warranties of the work and craftsmanship?
Workmanship to products, right?
Warranties, got it. Or certain.
Yeah. So when you go to buy your business, hey, the buyer's going to try to beat you down on the price no matter what. I mean, it's just why wouldn't they? One of the things that we've seen is a lot of times they try to devalue companies based on the warranties they promise. Like if you're doing business with Costco, for example, and your product's in Costco, Costco, they have the liberals warranty in there. It's actually not a warranty. It's more customer satisfaction warranty than a defense.
Exactly. The 5-year-old couch we can take back.
Exactly. Or the dead Christmas tree before Christmas you can return. It's like I've seen that. I was blown away when I saw Christmas trees come back. Anyway.
I know.
But that's Costco. I mean, it's what they're known for, right? But it's not Costco doing that. If you want to do business with Costco, there's a book written how many companies Costco's ran out of business because of their warranty. They're the distributors and manufacturers is honoring that warranty, not Costco. And so if you don't plan correctly, you can be, and that's a big portion of your sales, you're going to get devalued. Mm-hmm. And so what we do is we'll build an 831B plan, put some of the sales proceeds into this thing, if leading up to that. Now, I have a lot of business owners that have 831B plans for the sole purpose of their warranties. The best example I give is auto dealers. Auto dealers own a ton of these plans. If they're trying to push you for a service contract, when you go to close on that vehicle, even when you pay cash for it, they're still trying to get you to buy a service contract. Well, it's a very, very profitable business, but it's also all those premium dollars are going into an 831B plan that the owner of the franchise dealership owns. It's a huge, huge amount of revenue there for those business owners. And so that's warranty stuff. And again, it may be new to a lot of your listeners, but if you're offering any kind of warranty out there today, I think it's just to be able to take some dollars and park them off to the side. Mm-hmm. Because you literally use it after tax dollars anyway to honor the warranties, like HVAC guys doing service contracts, anybody doing any of that stuff where they're pre-buying it and you're not able to expend some of those profits out. You got to recognize that all as income today. Well, that's not an efficient way of running a business. When I just booked the liability for the next 3 years, I got to send a tech out to check on the HV system and the heating system. I just hope next year I've got the same revenues coming in. I can afford it. But if I don't, what am I going to do? And that's really the risk business owners take all the time. And so when it gets to the transaction part of it, though, I think it's just, again, taking apart. All you're doing is deferring the taxes on that, but you got a lot more money to work with, God forbid, if you need it. And that's really what the incentive was designed to do, the tax code.
That makes sense. So let's talk about it as it pertains to the sale of a business. So when did they talk to you? At the end, at the beginning, they've got an offer? What time do you like to talk to clients about this?
We just like you, I'm sure you work with a lot of attorneys on these transactions. And I think when that starts to go down that road where there's a purchase sale agreement that's put in place and that kind of stuff, and then what's in the contract? We want to dive into that too. What are the inherent risks that you've taken? And every industry's got its own little different nuances, but that's what we're going to get into.
So as we're going down the road of a transaction, when we're drafting the PSA, purchase sale agreement, that's when we call on you. That's when we bring you in to look at it.
Absolutely.
Got it. Okay. Got it. And do the deal size, does it have to be a certain deal size?
Not necessarily. I mean, it depends on it. I would tell the seller if they're carrying a good portion of the no, because their value of their business was blue sky or rep and warranty and all that stuff. I don't know if there's any, just to put $100,000 away on tax deferred basis on a $1 million sale, it would be worth it, honestly. That bucket's sitting in the back room. And one of the things that we get told a lot is it's like, I'm glad I did this because, man, it's nice knowing that is in the back room for me if I need it. And hey, you hope the transaction goes well, everything's good. You got your note, you got paid off, whatever on that end. And then eventually you just shut this thing down anyway. And you pay long-term capital gains anyway. But meanwhile, you're able to defer the taxes on that and have just more money to work with. God forbid if you need it. And like I told it's an insurance company, it's an insurance policy. But if you need it, you're not having a good day. I don't care what insurance you buy out there; it's not a good day if you got to use insurance. And you're going to be thankful you got it. And ideally, though, everything went smoothly and you don't need it. Okay, well, you just deferred the taxes on it, but meanwhile, and that's true risk management. That's true risk mitigation. The other one I wanted to hit on too is if you offer a lot of warranties, you may want to get us more involved in it before you even go to sell, because you're going to want to add, you're going to want a bucket of money set aside for that warranty risk, because I've seen it over and over again where they try to devalue companies based on the warranty so now here's the argument. The new owner is going to have to honor your warranties. Meanwhile, you made the money on those.
Yeah. Yeah, they've got the expense. They have to make good on the warranties.
Yeah, and so now we can build this 831B, fund it, and know that's already in place. So when that question comes up or that concerns, you're able to say, no, I'm going to leave this company open. I'm going to leave this 831B plan open. In the event of a warranty, these are the funds you can draw. Yep. And we sit, and believe me, we get involved in that. We're the administrator of the claims. We adjudicate. We know the track history of the business owner. They don't get to play games. If all of a sudden they have a big spike in claims and warranties, there's going to be some questions. We do that. We understand that part of it. But and most business owners don't go down that road. But however, we've had experiences where we've seen like, okay, now they're going to try to abuse it, and it's not as easy as people think. There's rules and regulations to all these things. So
I'm a simple thinker. I have to walk me through the money. So, and I'm just using $1 million. So they're selling for $1 million. If they do the 831B, they put 100,000, and it doesn't have to be 100, it could be whatever. They put a certain dollar amount into this 831B plan. So that money is not taxed. It's pre-tax dollars. It sits in that for how many years? How does that work?
Well, it depends. It depends. Now, it's $1 million. Obviously, it can be set in a money market. It's going to be in a bank account. It's either going to be in the bank account of the owner of the 831B plan. So these are C corp, right?
So that's making money. It has to be conservative. You can't put Bitcoin, for instance, right?
That's exactly right. We get that question asked a lot. So I'm glad you had that. No Bitcoin.
Conservative. And then it sits out there for a certain period of time.
And a lot of times it depends on the term of the agreement. We can do 3 or 4 or 5 years tells on policies. It could be a short-term deal. It really depends, right, on the transaction itself, on when that money needs to be at risk.
Okay. At the end of that period, well, if they use it, if they need it, they use it, right? If they don't need it, what happens?
Well, they can literally set it down and pay capital gains.
Okay, they just take it out. And does their basis change, or do they offset it against it?
Yeah, well, they're through claims and or fees, right? So our fees and all that stuff get put in there. So, yeah, there are bases that increase there, absolutely. I mean, it is another entity in itself.
The original basis, like if you have $1 million salary, you've got a basis in that business and say 200,000. Does that basis transfer over into that?
That's a separate entity.
Separate. Okay, got it.
Yeah.
Okay,
yeah.
But they have new basis that's offset with expenses and that sort of thing within the plan, and it's a secret.
100,000 in premium, yeah.
Yep.
The other thing about I was going to mention was there's also some. If they put 100,000 away, they're actually going to have $200,000 in coverages. The way we do our planning. Because we do, there's some pooled risk there that business owners have to have. And that's really that's the details of the plans. I was talking earlier about the 4-part test. There's details in that. So I always make sure business owners understand that when you do these things, you're not just going to own 100% of your own risk and call yourself an insurance company. There has to be a distribution of risk. And that's really where a lot of business owners have gotten in trouble in these plans, where they haven't been able to completely outline and make that do a bright line test where that is absolutely true. I have a distribution of risk.
Yeah.
But we have very large pools. We have 400 to 700 participants in our pools today. So when claims do happen, it's true insurance, meaning that it's spread amongst many different operating companies, and they're able to share in their risk. You think about any company with the name farm in it that's an insurance company. You think of any mutual company that started with the name in it. Those all started as co-ops. Allstate Insurance started as Sears and Roebuck's warranty company, for example. All those started originally. Now, these are 100-year-old companies, but they all kind of got together over 100 years ago and said, hey, we'll share each other's risk. And that's essentially what we're doing today, taking some of these risks that insurance carriers aren't going to cover very well at all. I mean, we not even talk about the thing called enterprise risk management, where we talk about supply chain risk, we talk about cyber risk, we talk about brand protection today. I mean, most business owners, when they go to sell their company today, what do they value most? It's their brand. It's their reputation in the community. It's the consumer confidence that's driven by your brand. That unfortunately, the smaller you are and the bigger brand you have, the more exposure to risk you have. I mean, Target survived their big cyber breach, right? I mean, they still had Target's still around. You talk about a smaller retail company, they'd be done. Restaurants that have foodborne illnesses and get shut down for 3 days by the health inspector, I've seen it. They're done. And these are 4 or 5. I mean, those are risks that inherently just run in the day-to-day operations of the business, not the transactional risk. And so, with the supply chain risk, and then getting back to COVID, I mean, COVID-19, one of the things that's helped us to grow where we're at today is really the COVID, unfortunately. Because what we tell business owners today is like everybody should have their own PPP plan. It just needs to be self-funded by you. I don't think we can rely on the government going forward, nor should we. And if you can change the outcome into the future, this is just one tool that allows that to do that. I'll also tell you that we're heavily involved in Congress under this code, and we're bringing this attention to them. Just like you, a lot of the new, this is I want to say it's almost 38, going on 40 years ago, this code came into existence. Well, almost all your congress people today aren't aware even where this code exists on the books. And so we're having conversations with them in DC talking about, hey, you guys already had a plan on the books for a thing like PPP. The IRS isn't like these things. Yeah, there's some things that need to be cleaned up, made clearer, obviously, in my opinion. But at the same time, though, this is the new PPP plan. It should be allowed. Business owners should be able to allow themselves to build up a tax-deferred bucket of money, God forbid, in the event they need it, and not be relying on the government next time. And that's what's really kind of given us the ability to really get the message out. So
I love it. So you've given us a lot of information. I think I've understood maybe 10% of it. But what I want listeners to know is that you're an expert and you're someone that they should call and explore this. We're contemplating an exit. In fact, I'm working on one right now. I'm going to call you on it, send it, because we need this for this transaction. But it's something I'd never thought about before, and I think it's pretty cool. And I appreciate Jake as your associate who found me and told me about this. So somebody's interested in this. How do they get in touch with you, Van?
So Van at 831b.com is my email. Happy to field you there. I would go to our website, 831b.com as well, and really start to learn about the company, learn about this tool. It's not a silver bullet by no means, but it's a tool. It's another tool in the toolbox. And for the right client, it's a fantastic tool. And there's a lot of educational videos on there. Yeah. There's case studies on there. Just see how does this apply to me and what my industry. And then just reach out to us through there too. But I'm happy to take field emails, or when I talk to business owners today, and I don't know if we're making more risk takers, if you want to know the truth. One of the things I think about sometimes when I'm talking all the time, I talk about this great transitional wealth that's occurring. And I keep thinking, well, who's transitioning the small to middle market business owners? Who wants to buy? Who's willing to take the risk to run these companies? And when our typical client, which I'm sure it's your typical client, somebody in their 50s, husband and wife, poured every dollar back into the company, very successful, sent their kids off to college, and now the kids have no interest in running the company. And what are they going to do now? How are they going to? What's their exit strategy now? And I would tell you that utilizing this tool in a way that softens some of that stuff is a huge deal for business owners. And I think one of the best things that I would say that I didn't expect this, but it's nice to be known as this. I have a lot of business owners over the years have told me, Ben, I just sleep easier at night knowing I've done your program. And that's probably the greatest compliment any risk manager can get from their clients. And I love what we do. And I think every business owner that are out there that has taken the risks, took an idea, ran with it, turned into a profitable company, has employees depending on them, owes it to themselves to look into these types of tools. Because I can tell you this, big companies have been using it for a long time. And if you're not doing it, your competitors are doing it. And it will put you in a better competitive position. God forbid if anytime the economy takes a step back, you have a tax-deferred bucket of money that you're not relying on a bank for. I mean, it's just the efficiencies it brings in the back room. I can't speak highly enough about it, because I just think it's more options on the table. And the more options you have, the better decisions you can make for your business.
Yep, that's great. Better tools. And as a hobby farmer, I'm a scratcher. We like tools.
So we do. I'm looking forward to that.
There you go. There you go. So 831B is a way to minimize your taxes, defer your taxes, and also reduce your risk in the sale of a business and in the operation of a business. Thank you so much, Van, for joining us on the show today. We sure appreciate it. And until next time, this is Rick, the M&A cowboy out of Heber City, Utah. Thank you for joining.
Thank you for attending our podcast. We invite you to join us for future episodes of M&A, Murders and Accusations, the good, the bad, and the ugly of selling your business. You can also visit us at www.bsalesgroup.com or email Rick directly at rick@bsalesgroup.com.